We are living in the greatest wealth transfer in the history of mankind, and how you react to this will determine whether or not you end up financially secure in the future or if you're going to be struggling to survive. However, if you do take advantage and position yourself well, you very well could 10x your entire portfolio or net worth over the next 10 years. And this is my plan to 10x my wealth through high inflation over the next 10 years. Now, the changes that are coming that I'm going to describe to you in this video are going to shock you. We are going to take a deep dive into our current monetary system, and we are going to understand what has happened in the past to get us to where we are today, and we are going to understand and illustrate the new ways that the riches of the future are going to be made today. Now, before I start getting into the history lesson, I'm just going to say I'm not calling for any sort of market crash, stock market crash, real estate crash, or anything of that sort, and I'm not going to get you emotionally riled up and fearmonger you and then try to sell you something expensive at the end of this video. I have simply been very interested in this topic for the last 12 months because I myself personally have a multi-million-dollar portfolio that I'm not only just trying to grow, but I'm also trying to protect it from inflation's erosion. So what I'm doing here is I'm just giving you my insights, my thoughts, and my beliefs based on all of the research I've done on the internet, all of the books I've read, and all of the people that I've talked to, including my friends that are much smarter than I am. Now, I'm going to warn you, this isn't going to be like a very basic video that's extremely easy to follow. So if you have a short attention span, I would highly recommend you save this video and watch it later. Now, in order to explain to you guys why I think we'll be able to 10x our entire net worth over the next 10 years, I have to give you a brief history lesson on some of the things that happened in our monetary system that changed things forever. 2008. Alan Greenspan was the chairman of the Federal Reserve in the early 2000s, which is the central bank responsible for setting monetary policy in the US. Leading up to the crisis, Greenspan had lowered interest rates and stimulated credit growth to deal with the fallout of the tech bubble bursting. The easy monetary policy, combined with a new law called the Commodities Futures Monetization Act, meant that over-the-counter derivative growth exploded. This meant that banks and financial institutions were gambling excessively on the performance of different securities. Now, I know that may sound a little bit complicated, but basically that just meant that banks and financial institutions were taking on massive risk. This included credit default swaps, mortgage-backed securities, and collateralized debt obligations. Now, all of these contracts meant that counterparty exposure exploded, but this was by regulators unseen due to the shady reporting requirements. Now, as all of this continued, lending standards began to decline to grant more mortgages to low-income and subprime customers. More and more banks began to gamble with each other on the direction of the housing market. Now, this didn't last forever, obviously, and the unwinding began when the underlying mortgages began to default, meaning that the people that owned the mortgages could not make their payments anymore. The derivatives written on these securities began to collapse in value, and slowly bank after bank blew up. Bear Stearns got into a cash crunch on March 12, 2008, and their CEO went live on television talking about the firm's stability. 4 days later, the Federal Reserve backed JP Morgan to purchase Bear for $2 a share, with the Fed absorbing the toxic assets in an LLC they spun up called Maiden Lane. The Fed lent $28 billion against the assets in Maiden Lane to help finalize the sale. A few months later, AIG, the insurance giant, started defaulting on massive amounts of credit default swaps it had written on mortgage-backed securities. These contracts were essentially insurance agreements to cover bank losses in case the mortgages were not paid. And once the homeowners began failing to make payments, it meant that AIG incurred $25 billion in losses. So the Fed and the Treasury injected $85 billion and then eventually $142 billion to save this failing giant. And this trend of the Fed stepping in to save the day is a very important key that you want to make a mental note of here. Next up on the list was the investment bank Lehman Brothers. Lehman was one of the first Wall Street firms to get into mortgage origination and had even bought a subprime lender called BNC Mortgage. It wrapped up these mortgages into securities and sold them to other prime banks. In 2008, losses began piling up and their hedges proved to be ineffective due to volatility. By September, they were on the brink and the only buyers, Barclays and Bank of America, fell through. They declared Chapter 11 bankruptcy on September 15th. Crucially, this caused panic because the Fed had not stepped in to save this systemically important bank. Now, I know this may sound a little bit complicated, but what happened in 2008 was very, very important to understand because that is when things started to change in our monetary system. It's because of these changes that makes it almost crystal clear why we are going to be able to 10x our entire net worth over the next 10 to 20 years. Now, after the collapse of Lehman, markets entered free fall. The prices of mortgage-backed securities, stocks, and bonds all collapsed as a massive flight to safety developed. Everything was sold in a desperate bid to raise cash. Fortune 500 firms like GE, Ford, and McDonald's panicked about payroll since they used the short-term debt markets to get cash for employee paychecks and the markets were frozen. In fact, according to New York Fed President Timothy Geithner, we were a few days away from the ATMs not working. In the depths of the crisis, the Fed and the Treasury worked together to launch new programs to save the failing system. The Treasury launched TARP, TARP, which aimed to purchase huge amounts of toxic assets from the banking system. It disbursed over $443 billion to stabilize the markets. However, this paled in comparison to the massive wave of money printing or money creation that was done by the Federal Reserve. Now, prior to the crisis, the Federal Reserve had $800 billion on their balance sheet. But as bank after bank began to fail, and Fed liquidity injections began to ramp up, their balance sheet went from $800 billion to $2.2 trillion. Markets, which were in free fall, slowed their decline and began to bottom March 2009. Slowly, the cracks in the system were papered over and stocks began a slow and steady ascent. Hundreds of banks failed because they were too underwater to be bailed out, and FDIC came in and put them into receivership before winding them down. The markets had seen the largest burst of money printing since World War II, and many were terrified of the consequences. Many economists, particularly those with a libertarian bent such as Peter Schiff, immediately decried this reckless behavior and predicted hyperinflation as early as 2011. From August 2007 to August 2011, gold ripped from $660 to a record $1,840 per ounce, and silver from $13 to $41 per ounce. And this was all because of the fear of inflation around the corner. Now, take a mental note of that because that is also an important part of this video. The Fed's balance sheet exploded to $4.4 trillion by 2016 as program after program shoved more and more money into the banking system. However, the inflation that many economists feared never came. Now, despite the massive stimulus programs and bank bailouts, the CPI, which is the Consumer Price Index, remained relatively steady around 2% for the next decade. So how is that possible? How can they print trillions and trillions of dollars, but inflation or CPI stays relatively stable? I mean, how could that make sense? Just a few years ago, they printed trillions of dollars and we saw inflation rise up to 9%, which is what they report, but inflation was definitely here and it's still here. So why didn't it happen last time? Well, in reality, there are two economies. There's the real economy and the financial economy. The tidal wave of new money that the Fed printed did not cause inflation in the traditional sense because the money did not flow into the real economy. The goods, the products, the services, all of the things that you and I consume on a daily basis. The money instead flowed into the other economy, the financial economy. This is going to be your stocks, your bonds, private equity, and commodities. So in reality, inflation did happen, but a majority of it was not in goods and services, it was in assets. When the Fed does QE, or quantitative easing, or money printing, or money creation, whatever you want to call it, it is essentially creating bank reserves. This is essentially cash for financial institution and allows them to trade and transact with each other easily. By printing more bank reserves, the Fed was putting trillions of dollars in the hands of the banks who turned around and either lent this new money or invested it. Soon after this, the S&P 500 began its biggest bull market in history. The Fed slammed interest rates down to zero, helping to boost asset prices as borrowing to speculate in the stock market now became very cheap. the Fed was also trying to manipulate the real economy with low interest rates, stimulating credit creation and thus, in theory, improving consumer spending. However, this creates a black hole of debt. As interest rates plummeted, every single sector of the economy began to borrow heavily. Student loan debt, mortgages, auto loans, credit cards, and even the national debt of the government began to rise quickly. Something had changed permanently since 2008. Although economic growth stagnated over the next decade, the markets continued to grind higher week after week. With each QE program, each new liquidity injection, SPY rose upwards despite the economy going further into debt and growth not keeping up. Now, shockingly, if you divide the S&P 500 by the Federal Reserve balance sheet, that chart has been flat since the Great Financial Crisis. The entire rally that we've experienced for the last 16 years has been somewhat of an illusion. It is simply the result of a vast amount of new money flowing into the financial system. Now, this isn't to say that there has been no growth in some sections of the economy, just that the long-running bull market is heavily due to the quantitative easing or money creation that has been going on. And you can see this a little bit more clearly if you put the global liquidity chart on top of the S&P 500 chart. These charts are almost the same, and they certainly behave in the same way. Now, the recent divergence is due to new ways that the central banks have found to add liquidity, but these additions don't show up on their balance sheets, so it's hard to track. The truth is that the markets have become very, very dependent on monetary easing. Addicted to the heroin of quantitative easing and low interest rates, banks were bidding up the price of equities every single day. The massive wave of money that the Fed created was trapped in the financial economy, pushing the prices of everything higher. The S&P 500, we can see here, has increasingly run ahead of real economic growth. This process began in 2008 and was occurring during the 2010s, but this process accelerated even more after COVID. Another fun chart to look at is this one, where you have the Dow Jones in US dollars on top of the Dow Jones in grams of gold over time, which is very commonly an inflation hedge if you remember from the beginning of this video. If you look at the price of the Dow Jones in grams of gold over time, it looks flat. It looks like it's been in the exact same spot for the last 2 decades. The market overall has become fragile, and the Magnificent Seven, which are those high-flying tech stocks like Facebook, Google, Amazon, are an increasing share of the S&P 500 index, and their outperformance has been pulling the market higher. Now, they make up almost a third of the index, which has 500 stocks in total. This can increase with time as the S&P is market cap weighted, so these few equities alone can pull up the index by themselves. We can further see this overvaluation of stocks via something called the Buffett indicator, named after Warren Buffett. This tracks the market cap of all equities divided by real GDP, or gross domestic product. As you can see, the average for the last 50 years has been 95%. And whenever we go above this ratio, stocks begin to get overvalued. In 2007, we were at 102%, but now we have run up to a shocking 185%. And I want to reiterate this again, because I'm not saying just because things are at all-time highs like stocks and homes and whatever else, and because they're currently overvalued by some indicators, that they're going to crash. I'm rather trying to point out the inflation in these assets that we are experiencing, that we are seeing, and this very well may not come down unless the Fed reduces the amount of money in circulation or unless the system breaks. This whole stock market rally has served to enrich the wealthy people of the world, and this is asset price inflation. This is another major key that you need to understand if you want to get on the right side of inflation and 10x your portfolio in the next 10 years, or at least protect yourself from it eroding away. This structural shift since 2008 meant that equities no longer followed fundamental cycles of growth and contraction. Instead, now the correlation between global central bank balance sheets is almost 1, meaning every new cash infusion, the markets rise by the same amount. Now let's shift a little bit and talk about the real economy. The real economy's money supply is measured by something called M2. This includes deposits at all of the banks and the cash in the money market accounts. Despite the massive QE programs since 2008, the money largely did not flow into the real economy. And you can see that here in this graph put together by Peruvian Bull. As you can see, the first time there was a massive increase in the Fed's asset price side, but no corresponding increase in M2. Same as the second time, but no fiscal deficits, so only bank lending grows. And then the third time, which was the money printing that was due to COVID, which was bigger than all of them, you saw a blip and a larger increase than ever before, which is why we saw inflation in the real economy higher than it was since then. But a lot of that flowed into assets this time as well. And even though I said this was a little blip, it was a 42% increase in the broad money. This chart shows money flowing into the financial economy until the third QE wave, which had a much bigger impact on M2 and thus CPI. More money chasing the same amount of goods or assets means prices go up. There are two main ways in which the bank reserves can make their way into the real economy. First, banks can lend money to consumers to spend. This can be a mortgage for a house, a car loan, or simply personal credit. This type of growth is slow and steady, and this is exactly what accounts for the gradual growth that you see in the M2 graph. The other way that bank reserves can travel from the financial to the real economy is through government deficits. Whenever the US Treasury sells a bond, it receives money from a bank called a primary dealer, and then it can turn around and spend this money on healthcare, wars, infrastructure, or social programs. This means that the money now moves from the financial economy into the real economy, stimulating M2 money supply growth and thus inflation. So the real formula for inflation is QE plus government spending equals inflation. In the aftermath of COVID, the Fed embarked on its largest QE program yet as stocks and bonds collapsed. At the same time, the government ramped up spending to fund vaccines, send stimulus checks, and pay for unemployment benefits. The combination of these two meant that one, new money was being printed by the Federal Reserve, and two, that money was being moved into the real economy by way of deficit spending. M2 money supply exploded by 6.2 trillion or 40%. Inflation, which had remained subdued for over a decade, now began ripping higher throughout 2021 and 2022. As the amount of money circulating in the real economy rose, logically, prices did as well. Of course, supply chain issues can also be blamed for some of this, but inflation stayed well elevated even after the lockdown subsided. Inflation hedges soared upwards. In August of 2020, gold skyrocketed to over $2,000 an ounce. And a year later, the crypto bull market started as well. Bitcoin ran up all the way to $69,000 by November of 2021. Now, to cope and deal with this inflation, the Fed had to respond. So in March of 2022, they began their most aggressive tightening cycle ever. Starting from zero, they hiked interest rates to 5.3% in just a year and a half. However, this time was a little bit different because this created an entirely new crisis. This created a debt crisis. And if you're wondering how you're going to 10x your money and protect yourself from inflation, we are about to get there, and I'm about to show you exactly what you need to do. But understanding this is extremely important, and we're almost there. You see, leading up to this, the government had been borrowing heavily for years. The debt was at 23 trillion and rising steadily. Presidents from both parties, Democrat and Republican, had been running deficits to fund wars, social programs, and subsidies. And politicians, as they usually do, kicked the can down the road. Don't expect anything else from them. After COVID hit, the national debt soared due to new stimulus programs that were created to offset the damage done by the lockdowns. As the Fed hiked, this created a massive spike in interest expense as both the total level and the rate paid on the debt rose upwards. In 2023, for the first time ever, we paid over $1 trillion alone on the national debt. Now, traditionally, and it has happened in the past, the Federal Reserve can raise interest rates to deal with inflation effectively. This worked in 1980 under Fed Chairman Paul Volcker because total debt to GDP was low and thus rates could be hiked to an eye-watering 18%. However, this begins to backfire when debt to GDP is too high. This is called the debt paradox, and once debt levels get too high, anything that the Fed does just makes it worse. If they lower the rates and print more, the already high fiscal deficits mean that the money they create flows into the real economy and causes inflation. This further increases government spending as the cost of Social Security, public works, and the military rises. To fund this spending, the Treasury borrows more. And because of that, the debt grows faster. And the other option, of course, is that they raise rates, which typically, like I just said, does lower inflation. However, this time, with debt levels being historically high, interest expense for the government starts to explode, which we are already seeing. Higher interest rates, which again is a protocol to control inflation, means that the government is going to spend more on interest and they're going to have to borrow more to spend more, which causes inflation. So the main tool that they use to fight inflation is going to actually cause inflation. This is a devastating feedback loop, and in the long run means that our debt growth is exponential. And since there will not be enough demand for this debt, the only other option is going to be for the Federal Reserve to monetize it. Or in other words, they are simply going to have to create the difference, literally create the money into existence. And if they don't, the government will default and die. So, yeah. Ironically about this whole thing, the higher and the longer that they hold interest rates, the more likely they are going to have to print, and the more likely they are going to have to print more. Now, the Fed has already chosen the second path. This year, the debt is going parabolic and is rising by about $1 trillion every 100 days. In fact, we are now paying more on interest costs than we do to fund the entire US military. If all of the debt is refinanced at the current rates around 5%, we would be paying a staggering $1.6 trillion just of interest every single year. And this is a third of all tax revenues. When the time comes to pay off existing debt, the Treasury issues new debt to cover both the principal amount previously borrowed and the accumulated interest. In 2024, approximately $8 trillion of debt is being refinanced. This means interest expense will move up again on the debt, further worsening the spiral. Obviously, the longer the Fed holds rates higher, the worse the problem becomes. The Congressional Box Office estimates that the national debt will grow to $48 trillion by fiscal year 2034. But this doesn't take into account the gravity of the situation. In another projection, the expectation was $40 trillion by 2027. In February alone, debt rose by $280 billion, and for the first 2 months of the year, it increased by a total of $470 billion. At the current rate, the debt is projected to reach $37 trillion by the end of this year and $40 trillion by the end of 2025, surpassing the Congressional Budget Office's forecast by 2 years. Now, this is the question that we have to ask. How is this massive amount of debt issuance going to be absorbed? In the last great financial crisis, we escaped largely by borrowing a lot of it from foreigners. In fact, they bought almost 3/4 of the debt from 2008 to 2016. However, in the recent COVID crisis, the foreigners only bought a fraction of it. This gap in financing had to be made up somehow. With the banks already stuffed with treasury bonds and retail investors basically tapped out, the Fed had to print the difference. In 1 year, the Federal Reserve became a larger holder of government debt than all other global central banks. The Fed is now on the hook for keeping the global monetary system running. Without added liquidity, things start to fall apart quickly. Not even a year after the Federal Reserve began to taper, banks started to blow up. Starting with Silicon Valley Bank, within 2 months, 5 more banks had failed, including a globally systemic important bank, Credit Suisse. Authorities responded with a new solution this time. Instead of doing QE, they would find hidden ways to stuff more liquidity into the financial system. This started with the Bank Term Funding Program, also called BTFP, which allowed banks to borrow against bonds at face value instead of the market price, essentially allowing them to not realize any losses on these securities. This program ballooned to $167 billion at its peak. Another way the Federal Reserve can quietly inject liquidity is by drawing down the reverse repo facility. This is a place where banks and money market funds can deposit cash and receive treasury banks as short-term overnight loans. These bonds can be used to satisfy collateral or legal requirements. At its peak in late 2022, there was over $2.5 trillion parked here. Any cash left here is essentially frozen as it is held on the Fed balances sheet. During 2023 and 2024, this has been falling, which means cash is re-entering the banking system. In total, around $2.1 trillion has moved back, adding more liquidity and helping to boost asset prices. At the current pace, reverse repo could be completely drained in a couple of months. The Fed's current taper is also somewhat of an illusion. Although the Fed is publicly reducing its balance sheet, it is doing so in a way to minimize the loss of liquidity. Now, it can do this by only selling short-term bonds and keeping the long-term bonds, because the longer the bond duration, the more capital banks have to hold as reserve against losses. Swapping long-term bonds for short-term bonds is thus stimulative, as it frees up money that banks can use to speculate on other assets. As we can see in this graph, which breaks the Fed's treasury holdings down by maturity, during the last few easing cycles, and especially after COVID, the Fed added a lot of long-term bonds to their balance sheet in order to take it off the books of the banks who were stuffed with them. However, as the Fed began to taper in 2022, this duration risk was not laid off, meaning they did not sell these long bonds into the market. The breakdown is even clearer to see in this rate of change chart here, where we can see the Fed purchasing large quantities of every maturity during COVID and the subsequent QE programs, and then easing up on purchases by 2022. In fact, what is shocking here is that during the taper, not only did the Fed not become a net seller of long bonds, depicted in yellow, maturities over 10 years, but in fact, the holdings increased as the Fed laid off the rest of the bonds. This was another way of secretly adding liquidity to the system without it showing up on their balance sheet or in public announcements. And the Treasury is joining the effort with a change in its issuance schedule. Last November, they published a press release stating that they were reducing the amount of long-term bonds and increasing the amount of short-term bonds to be issued. In fact, they had been doing this for several years, and the problem has gotten worse again since the Fed's cutting cycle. This type of stuff is the behavior of banana republics, or poor third world countries who cannot convince anyone to lend to them long-term, so they rely on short-term funding. All of these actions have simply bought more time and have stopped banks from blowing up. The change in debt issuance means that more money is freed up so that banks can hedge against their losses in other parts of their portfolio, and this is stabilizing the system. Despite what people may think, inflation is not a once-in-a-decade phenomenon. It comes in waves. Even during the 1970s, there were multiple waves of inflation, each one being higher than the last one. This year, the deficit is at 1.1 trillion, and we are only halfway through the fiscal year, which started in October of 2023. Inflation bottomed at 3.1% in January of 2024, but has slowly and consistently been rising since then. If the government deficit continues to remain this high, we are not going to have an option. Hiking up interest rates to combat inflation is going to make the debt worse, and lowering them will just cause more inflation. The Fed is trapped in a black hole of their own design. Now, I've already mentioned this early in the video, but I'm going to restate it here because I can imagine a lot of people are going to leave a comment not understanding why they have to print more money and why there's no alternative. So if they do not run QE, the Treasury is going to run into a problem of who is going to buy the bonds. The banks and money market funds are already stuffed, and the retail investors can only buy so much. If nobody bids at a Treasury auction and gives money to the government, this means that the government will not have the money it needs to operate and spend money on all of the things that it does. If the government went bankrupt and could not secure any more money, very quickly, there would be a lot of pain. Millions of people would lose their jobs. Financial markets would literally melt because Treasury bonds are like the backbone of this entire system, and they are literally collateral for so many different types of trades in the financial system, and we would surely have a massive and painful depression. So the easier, less immediately painful, and faster solution is to just create the money, just create the difference. And since they have no option, you know what that means? It means that generational wealth transfer is going to happen. From savers to debtors, from bonds to inflation hedges. And if you are on the right side of this equation, you will profit immensely. And those who are ignorant, or those who just can't be bothered, are going to see their wealth erode and slowly disappear. So this is the moment you've all been waiting for. What do we do? Well, there are multiple answers to that, but there are only two things you need to do. It's very simple. The first thing is you need to have a diversified portfolio with uncorrelated assets. The second thing is you need to own assets that are going to increase in value due to inflation. These are inflation hedging assets. There are three categories of assets that rise during inflation. You have low risk, medium risk, and you have high risk. Starting with low risk, we have gold. Gold has been an inflation hedge for a millennia. In fact, in ancient Rome, generals got paid in gold. If their families held on to that gold, it would roughly have the same purchasing power today. A high-end tailored toga would cost half an ounce today, which would be roughly the same as a nice Italian custom suit. The price of 1 ounce of the metal has recently jumped up to $2,400, and this was a 23% gain in 6 months. This is a massive move for an asset that has a $10 trillion market. Now, as I'm filming this video today at the end of April of 2024, the current price of gold is $3,300 per ounce. And I'm super glad that I bought gold when I started learning about economics and investing and diversification and all that back when it was only $1,700. I only wish I bought more, of course. And that's okay because I actually just recently bought a ton of gold, even at this price right now. Land is also a great investment. There's only so much available and it is needed for farming, housing, and businesses, making it a valuable and intrinsic asset. Real estate has an average rate of return of 8.6%. According to the Fed, has also made significant purchases of mortgage-backed securities during their easing programs, supporting the housing market via QE. Additionally, if you get low rates on the debt used to purchase the land, you can easily earn free money as you are borrowing at a lower rate than the return, producing a positive spread. Now, moving on to the medium risk stuff. Here at medium risk, you're going to have equities. Stocks are a higher risk but higher reward play. As of February 2024, the S&P 500 has delivered an average annual return of 12.68% over the past decade, assuming dividends are reinvested, of course. When adjusting for inflation, the average return including dividends over the same period is 9.56%. Of course, this is not evenly distributed, and some stocks serve as much better inflation hedges than others. For example, oil and natural gas stocks. Fidelity's Select Energy ETF is up 62% in the last 5 years. High-flying tech stocks also outperform, mainly due to their size, which draws in more capital as the S&P 500 market cap is weighted. The Nasdaq 100 ETF, QQQ, is up 33% in the year, as its biggest holdings, Microsoft, Apple, and Nvidia, have rallied. And now we have high risk. So for high risk, I have cryptocurrencies. These are some of the highest risk plays, but also the most sensitive to inflation. In 2021, as inflation soared, Bitcoin ran all the way up to 69K before pulling back due to the Fed rate hikes and withdrawal of excessive monetary stimulus. As an asset, Bitcoin functions like digital gold with a fixed supply cap and a steady issuance schedule that is impervious to rapid change. The price is rallying again. As spot ETFs have been approved, now trillions of dollars of institutional money can flow in. Bitcoin does have extreme volatility, as the average drawdown from the peak each cycle is around 80%, but this volatility has been dampening with time as the market cap grows. So here's the major key, and this is what we call diversification, or at least what I call diversification. You have 30% in real estate, 30% in business, 30% in reserves, out of which 20% of that is gold, and then you have 10% in speculation. So again, I think this goes without saying, but none of this is financial advice. Everyone is different and everyone likes to invest differently, but in my opinion, being diversified with uncorrelated assets in this way is something that I really like. Now, for me, I'm a little bit younger and I want to take on more risk because I have a high risk appetite. That's just the type of person that I am. So I'm going to just go out there and be honest and say that I have more than 10% in speculation, and most of that speculation is definitely crypto for me. So now let's run a couple simulations of a portfolio so that we can see what happens to your portfolio over time based on the investment decisions you make and the ways you diversify your money. We will assume no contributions and no withdrawals, and this will be pre-tax, and we'll make sure to rebalance this portfolio every single year. We'll also adjust for inflation in all of these simulations so that you can see your wealth really actually going up, your purchasing power actually significantly increasing over time instead of just seeing your portfolio inflate. Now, the base case is just saying you do absolutely nothing for the next 20 years. You just sit on your cash and it sits in a bank account and does nothing. If we assume a base case inflation rate of 4%, which is higher than the target, but probably going to be closer to the actual rate of inflation when it's all said and done. Most outcomes of this type of investing will gain barely any purchasing power over the long run. So this is obviously something that you do not want to do because you are going to get screwed. Now let's start to introduce some risk. Here is an example of the basic risk parity portfolio. This is standard for financial advisors to recommend to clients, and it's basically comprised of 60% large cap US stocks and 40% US investment grade bonds, including US treasuries. As we can see, this portfolio does substantially better, but the median return will only net you $307,000 after inflation. The worst case only makes $160K after 20 years, which is a measly 2.3% real return every single year. Best case scenario with this type of portfolio puts you at around $550,000. Now don't forget, this is a 20-year time period starting with 100 grand, no contributions or withdrawals. So here's an example with some mid-risk investments. We will include a 20% REIT, which is exposure to real estate, 10% oil ETF, and 70% S&P 500. The median real return is 7.49%, netting you $422K after 20 years. The most optimistic case will return 11.5% in real returns, growing the portfolio to $875K after 20 years with a starting balance of 100K. Now, so far that's pretty decent, but I think that you could still do better. Now we are going to run a portfolio with more high-risk assets, but also inflation hedging assets, because we know that during times of inflation, these inflation hedging assets go crazy, and we expect inflation to be a problem for the next 10 years. This one has 20% Bitcoin, 20% gold, 20% oil, and 40% a generic S&P 500 index fund. The median return on this portfolio would net you $11.5 million after 20 years, and the most bullish case would net you $145 million. Now, of course, this is just kind of a fun one because it's based on the historical returns of Bitcoin, and as everybody knows, Bitcoin has gone crazy since the inception of it. And because of this, and very obviously, I hope, the most optimistic and even the median level of optimism in this portfolio are, for most people, going to be highly unlikely. That is, unless, of course, you got in very early. However, even the most bearish case of this portfolio possible would net you $3.2 million after 20 years. And that is, once again, adjusting for inflation. This represents a 32 times real gain on your initial $100,000. And now we are going to analyze and look at the most realistic portfolio and the portfolio that is closest to resembling what I mentioned earlier with the 30% business, 30% real estate, and 30% reserves, etc. Now, the only difference is that instead of 30% in real estate and business, I put 25% in each of those categories, and I put the extra in speculation because, like I said, I'm younger and I have a higher risk appetite. So this is what my portfolio looks like. But in fact, I may even have a little bit more speculation, but we're not going to talk about it. We're just going to analyze the portfolio. And as you can see, starting with $100,000, never adding or taking anything out of it, investing the dividends, rebalancing it regularly, and exposing yourself to inflation hedges and some speculation. After 20 years, we get to $1,096,000 after adjusting for inflation. So this is just a clean 10x. And this was from the previous 2 decades, which, as we know, because we explained in this video, the next 2 decades are going to be much more inflationary than the last 2 decades. And because of that inflationary itself, and because of the fear of inflation, these assets are going to rise more in the next 2 decades than they did in the last 2 decades. And that's why I'm very, very confident, and I fully believe, and I'm putting my money where my mouth is because this is how I'm investing. I fully believe that for the next decade or 2, we are going to see some crazy generational wealth happening. And now you can really see the power of adding asymmetric bets and inflation hedges to your portfolio. Even a small allocation, or maybe a little bit more than a small allocation, can have a massive effect on it. And by rebalancing the portfolio, the returns get evened out over time. And I also do want to mention that although we did the Bitcoin portfolio, which many people may just immediately dismiss, I would urge you not to, because yes, Bitcoin was a massive opportunity, and a lot of people didn't get in early enough for it to be like life-changing money, but a lot of people did. And if you pay attention to this kind of stuff, the next time an opportunity like that comes around, and it will, you'll be able to take advantage of it. And I personally know multiple people that got in crypto very early, and they have more money than anyone in the world would know what to do with. It's absolutely insane. All I'm saying is you will get your shot if you are smart about it. Now, you don't want to be that guy that takes out a second mortgage on his house and puts it in Solana, but you also don't want to be that guy that completely stays away from speculation because somebody on the news said it was a Ponzi scheme. You want to identify value, make a plan, be diversified, and extract the value. Now, this is exactly what I've been doing personally myself with my portfolio, and just in Q1 of 2021, I did 18% in one quarter. I rebalance quarterly or as needed because I'm more involved in the markets, because I'm younger, whatever. But yeah, it did really, really well. Shout out to Bitcoin and crypto and to speculation. And including hedges here are very key. If inflation does return, which as we all know now is very likely to happen, they will outperform everything else and add asymmetric returns to your portfolio, boosting your portfolio significantly, allowing you to build real wealth. Now, I got to give a shout out to Peruvian Bull because he helped me and him talk a lot, and we discussed these topics, but he helped me a lot with the research for this video. You can find his YouTube and his Substack with his newsletter in the description, which I read every single time he posts. He puts forth great content on the internet, and he's also very active on Twitter, which is where I found him. And he does a great job breaking down complex topics around macroeconomics. Now, if you guys want to learn more about me, you can watch my story video here where I talk about how I went from zero to where I'm at now. And if you want to watch a video I made explaining why I think America is headed for collapse, I made an entire documentary on that video, which there is a link to here. And I do have to mention, if you guys are interested in learning how to dropship, which is a way you can make money on the internet, it's an online business. We just dropped our new platform, which is completely free. It's howtodropship.com. You can go there, you can enroll for free, and you can get access to all of our videos and go through them and learn how to start your first online business and start making money.